will give us short introduction
Yeah,
about.
sure.
Namaskar and good afternoon to everyone connected to this webinar. Respected speaker to this webinar, Mr. Vaibhav Jain, sir. Our chairman, Mr. S.P. Sharma, sir. Members of DJBF RBO and members of AVP and other esteemed participants. I, Kajal Gupta, coordinator of this webinar, extend a warm welcome to you all in this program on behalf of Divya Jyoti Wellness Foundation RBO. As you are aware, the topic of today's webinar is valuation of ESOP. ESOP is acronym for Employee Stock Ownership Plan. Under this plan, employers offer their employees as a part of their compensation package the stock of the company at a lower or no additional cost that they can encash after a specified period at a specific price. Owning shares in a company indicates that you are a partial owner of the company. ESOP can align employees' interests with the interests of the shareholders. If the employees are shareholders, they may work harder to contribute to the success of the company. The companies need ESOP valuation for accounting purpose and tax purposes. As the ESOP as a part of compensation package is gaining popularity and number of assignments for this valuation in market are on increase, and we have chosen the topic for this series. We are sure that participants will find this topic useful and enriching for their professional practices. We are fortunate that a highly experienced and qualified professional, Mr. Vaibhav Jain sir, is taking this session on this subject, who will cover all the aspects of the details. However, before I hand over the mic to him, I will briefly introduce him to you all. Mr. Vaibhav Jain is a chartered accountant, a company secretary. Besides this, he is a law graduate and also a commerce graduate. He is a registered valuer and is among the first to acquire this qualification. Because of his nature to acquire knowledge, he successfully qualified Masters in Business Finance Certificate, an ISM Certificate Capital and Securities Market, Certificate course in Indirect Taxes from ICAI. He specialized in the field of valuation, GST advisory assurance, risk advisory, business strategies, and financial advice. He has been a special invite on IFRS, Indian Accounting Standards, Implementation Committee of ICAI. He is a visiting faculty to various organizations like ICAI, ICSI, CII, ANMI, and PHDCCI, etc. So over to you for the wonderful learning session for 2 hours. Thank you, sir.
Thank you so much, ma'am, for introduction to all participants. I think I am able to see some familiar faces who are far more learned, far more educated than the speaker of the day. That much, of course, I can acknowledge. And thank you so much for extending this invitation. And obviously, it is a mutual learning opportunity. I think such items also help us to learn with mutual interaction. So I think coming straight to the topic, what I've done is actually because sometimes there are certain aspects of employee stock option plan which are not very clear to all of us. That is why I have captured in the initial, you can say 15-20 minutes, we'll be concentrating on what is ESOP, what are the various terminologies, what is its impact on valuation, why reading the scheme document of a ESOP scheme, reading the grant letters, why it becomes important for a valuer while considering valuation, what kind of method one needs to pick up, because their ESOP valuation also can be done by multiple methods. So which method one should select, what kind of terms are there in ESOP policy, which will decide that this is the most suitable method. Of course, before starting also, all of us know that Black-Scholes is the most widely used method for ESOP valuation. But apart from Black-Scholes, also there are certain scenarios in which one has to adopt binomial, Monte Carlo, or intrinsic value. I think what are those circumstances? Those aspects also I'll briefly cover. Obviously, it may not be possible to touch upon them very minutely, but definitely I propose to briefly cover them. So anywhere any of you is not clear or you feel that certain aspect has left uncovered, please feel free to interrupt me, because I think we have sufficient time. 120 minutes is definitely something which is more than sufficient to cover the topic of the day. So I do not say that I'll be cutting questions. It is more beneficial that you raise questions, because by that all your colleagues and all of us, including me, will be able to learn something more than what I have brought for you today. I'll now share screen. Just a second. Hope my screen is now visible to you, and I'll go to the full screen mode so that you're able to. So if my presentation is now visible, hopefully.
Yes, sir.
Just a second. This one's yeah. So I think all these questions which come to your mind while looking at ESOP valuation or a ESOP scheme, I think all those I have tried to touch upon how to answer each of them. So from an Indian perspective, I think I was amazed to see when Divyaji used the word employee stock ownership plan, because this is more used in the US perspective. In India, we normally call it employee stock option plan, because that is the name. Companies Act 2013 and the preceding 1956 Act also carried for these options. Now, stock option is a right which is given to an employee to buy a certain number of shares. These number of shares are predetermined. The price at which these shares are bought is also predetermined. Just a second. मेरा लेक्चर शुरू हो गया सेशन मैं आ नहीं सकता मेरा सेशन चल रहा है 4 to 6 आई हैव अ सेशन हाँ हाँ ओके बाय yeah the right is available over a period of time, that means the vesting term which we normally talk of. So ESOP ecosystem will be conceptualizing and designing a ESOP scheme, legal compliances, employee presentation, implementation, and administration. This may not directly correlate to the topic of the day, but I think the terms which are very, very important is what is a grant price, what is a exercise price. The price at which the shares are offered to the employees is the grant price or the exercise price. Vesting period, the period after which the options can be converted to shares. That means normally what happens in a I think we'll explain that cycle, but today the options are granted, but they vest, or an employee becomes eligible to apply for those number of shares based on certain vesting milestones. Those milestones can be time, they can be you can in the events, or you can say milestones in terms of KRAs, KPIs also. Exercise is a action by an employee where they pay the price and they want to convert these shares in the options. And the exercise period is normally a period post the vesting date, whatever period a company permits. That say today you apply for a particular share, you are granted a particular share, there is a vesting of say 3 years. After 3 years you have another 10 years or 3 years or 5 years within which you can exercise these shares, and in case you fail to exercise, then your options will get lapsed at the end of the term. Now, example of vesting schedule. See, in this case, it is a linear option. That means every year, 25% shares are getting vested. You granted 200 options in 2021. The vesting happened 50, 50, 50, 50 in 4 years out of the 200 share options, which was granted. So the company grants the options and the granted options vest. The period between these two terms is known as the vesting period. the time between the vested options and the employees exercises these vested option is known as the exercise period. And obviously, once you have exercised, you have shares, then subsequently you can sell them at your ease and ability. Now, how does the employee benefits? So, say for example, 150 rupees per share is the exercise price, and the share price is moving upwards of 150. So, whatever level the share price is, that is the benefit which the employee gets. Why this benefit is required to be known? Because this benefit is actually the amount on which you are required to pay tax as on the date of vesting, as on the date of exercise, not vesting, exercise. Now, there are employee stock option plans. There is an employee stock share purchase plan. There is a stock appreciation rights. And then there are phantom options. These are typically type of, ESOPs. In a employee stock option plan, options which can be converted into equity shares on a future date are granted. Conversion of option in shares will happen on completion of the vesting period, and generally post conversion there is no lock-in period for equity shares. In certain cases, when the exercise is done in a pre-listing scenario, then there are certain lock-ins from the date of listing which are applicable in terms of the red herald prospectus of the company. Employee share purchase plan. Shares are issued to employee at a certain price. These shares have a lock-in period in which employees cannot sell these shares, and the employee needs to pay the price on the date of issue, that is on the date of which the scheme is implemented. These are concessional price shares which are issued to an employee. Stock appreciation right is a form. Am I too fast or is it fine?
It's fine, sir.
It's
Yeah,
okay.
yeah. So in stock appreciation rights, they are a form of a bonus compensation to employees. That means, say today you got a SAR of 100 shares, and today share price is 250, and you are eligible to SAR for 2 years. Now, at the end of this 2 years, if the share price is above 250 as on the completion date, then the differential is given to you as a bonus. So you never actually get ownership in the company. You never get the shares. You actually just there is a you can say the appreciation difference is what is given to you. Phantom options. They are a form of SAR where the share price over an established period of time is paid in the form of a free share. So sometimes in this case, they are not giving you any shares. Now this 200 shares, if they were worth 250 rupees each, and they became 350 worth, so it became worth of 100. So 100 by 100 rupees into 200 comes to 20,000. Now 20,000 by 350, I think those many number of shares you can be allotted if it is a phantom option. Obviously, I have not reduced the tax. In some cases, they even, to make it completely cashless, they also reduce the tax on these shares. Now, ESOP is also implemented through two routes. One is directly where the company engages with the employee, or where the company engages with the employee through a trust. And all types of ESOP, whether it is employee stock option plan, share appreciation rights, phantom option, employee stock purchase plan, all of them can work both in direct route and in trust route. Now, in a direct route, typically what happens? Employee is granted options to buy shares. Employee exercises the option, which is already vested in him, and the company issues the share. In case of a trust route, what typically happens is the company issues options to the employee, and it simultaneously grants a loan for subscription of shares, And the employee welfare trust subscribes to the shares of the company. Now, thereafter, employee exercises the vested options and buy the shares. The shares are transferred here, and whatever money the trust receives, that is used for repayment of the loan. In this scenario, sometimes certain profit or certain money gets accumulated at trust level due to some employee on whom shares got vested, they did not take, and those shares were used for future employees and for which fresh subscription was not made. I think those kind of surplus sometimes company is able to generate here, and also reduce certain expenditure which is coming into the P&L of the company. I think both the ways company is able to benefit out of the trust route. That is why there are some companies who go via trust route. Now, applicable laws: Companies Act, SEBI guidelines, FEMA, and income tax regulation. I think these are the regulations, because it is very important to understand the regulatory environment in which you function before you end up issuing a valuation report, because we are all aware that how deeply all our valuation reports are being examined these days by a regulator. So Companies Act 2000 and rules. I think I just yeah. So Company Share Capital and Debenture Rules 2014. Their applicability, eligibility, shareholders approval process, pricing, lock-in, accounting for ESOPs. I think these are the typical items which are to be, seen. Now, what is the basic here? So in Companies Act, I think they don't miss that slide, but primarily all employees are eligible. Full-time employees only eligible to go for a ESOP. Once a company is at least 1 year old, the company can introduce a employee stock option plan. Once the company introduces the employee stock option plan and the grant letters are issued, then at least 1 year of vesting period has to be there. You can't give a cliff option. Cliff option is sometimes at the date of a grant itself, you give it, or sometimes on a particular event you give it. So event based is allowed, but in any case, there has to be a recess of at least 1 year from the date of grant to the date of vesting. Shareholders approval special resolution, separate resolution for grant to subsidiary or holding company employees, or to identified employees equal to or greater than 1% of the issued capital. So in case you want to issue 2%, 5% to a particular employee in form of ESOP, I think there has to be a separate special resolution which the company must have passed. Pricing and lock-in related conditions are there. Now, accounting, I think we'll discuss in coming slides. In the SEBI regulation, all the regulations are same as Companies Act, except these are applicable only to listed companies, and the compensation committee, where the majority of members have to be independent directors. I think these are the two additional requirements in the SEBI regulation. Now, in case of ESOP, when it comes to tax, you have grant date, then you have vesting date. This is the vesting period. From vesting date to exercise period date, this is the exercise period. The exercise date is when the perquisite tax triggers, the amount on which an employee has to deposit the withholding tax with the company simultaneously with the exercise price to get the shares allotted. Now, in case of certain category of approved startups, there is a deferment of 5 years in which the company's you can say responsibility to collect and deposit withholding tax has been taken off, and the employee concerned is supposed to either dispose of these shares and get capital gain and pay tax within 5 years, or at the end of the 5 years of holding period, they will be required to pay tax. On exercise date, difference between the prevailing market price and exercise price is taxed as a perquisite. On sale of shares, the difference between selling price and price as on the date of exercise taxable as capital gains. This is taxed as capital gain. The difference here, this is taxed as salary income. So how does a FEMA regulation become applicable? When a foreign company wishes to grant options to its employees working in India or to employees of its subsidiary company in India. And when an Indian company grants option to its employees working overseas or to its employees of the overseas holding, joint venture, or wholly owned subsidiary. I think these are the two situations in which FEMA will come into play. Any questions so far? I think before FEMA, I'm of course yet to start FEMA because FEMA is a little complex piece. And I think thereafter we'll straight shift to valuation of ESOPs. Any queries till now? I'm assuming no.
So one query.
Yes, sir.
Basically, so if we are incorporating a new company, can we have a ESOP pool at the beginning itself, or we have to wait for 1 year?
So normally, typically, what happens is you do a board resolution that you earmark certain portion of the capital as ESOP, but the adoption and filing of ESOP scheme that can be done only once 1 year from the date of incorporation has been completed.
I have a second question on this as well. So what is happening is one of my clients is a startup incubator at IIM Lucknow.
Yes.
And they are asking it to earmark and file a ESOP scheme as the startup is getting incorporated at IIM Lucknow. Now the problem is the company was incorporated back in September, or now September is still 4 months away from today, but they are mandating a condition as an incubation program for them to allocate certain part, like 10-15% of their.
So you can do a board resolution. You can even do a shareholders resolution, and you can say that the formal scheme will be adopted in the annual general meeting or whatsoever, because September तक आपका वो time आ जाएगा AGM का. And I think that should work for them. And you can also support it with your chartered accountant or company secretary or a legal opinion stating that the Companies Act does not allow you to do it within 1 year of incorporation.
Okay.
Because ultimately, no IIM or no IIT will do anything against the law of the land.
Yeah, definitely. But the thing is that a lot of times what happens is the incubation managers are not aware of the law. So they certainly have certain instruction to them that, okay, for their incubators, they should need to have a ESOP pool. But
sir, pool is okay. So pool can, if you give a certified true copy of your board resolution,
3 months old, understand?
Then if you give a certified true copy of a board resolution which say we have earmarked this much for a ESOP pool, or you amend your articles to say that this much capital is earmarked for ESOP pool, I think they are sorted there. The adoption of scheme and all those things may not happen in the first 1 year. They can happen later also. Because in any, but the one thing which you have to be very particular about, no grant letters can be issued before the ESOP scheme is adopted.
Okay.
So if my understanding is correct, basically option pools can be created and no grant letters or anything can be issued before the scheme is launched or officiated.
Correct. And scheme can be launched only after 1 year of date of incorporation.
Okay. Thank you.
Now, I think just taking. So ESOP of a foreign security, ESOPs of foreign securities, where resident individuals can acquire foreign securities under the stock option scheme of its overseas parent / subsidiary company, provided the options are issued to the employee under a cashless ESOP scheme and does not involve any remittance from India. Typically, that is why we mostly see that when a foreign company issues ESOP to an Indian employee, they don't issue ESOPs, they actually issue share appreciation rights in most cases. In some cases, they end up issuing phantom options. An Indian company in knowledge-based industry may allow its resident employees to purchase the securities under ADR GDR linked stock option scheme, provided it is in accordance with the applicable guidelines. I think I have not come across practically any company doing so far. But in case any of you have any practical experience, I think I'm happy to share it online or offline. Now, yes. So example, 100 options are granted with the exercise price of 10 USD and the fair market value is 25 USD. Under the cashless employee exercises 100 options, simultaneously sells 40 shares to pay the exercise price, and the employee gets 60 shares because this is a cashless mechanism. In case of RSUs, since the exercise price is nil by default, it is like a cashless exercise only. Now, how does a cashless work? The employee issues the exercise instruction to the company. The shares are issued to a broker overseas who pays the exercise price to the company. Broker sells sufficient number of shares so as to recover the exercise price, brokerage, and other charges incurred at his level. And balance shares he transfers to a demat account, which is owned in the name of the employee. Now, ESOPs to overseas employee. Here, in the earlier scenario, it was a foreign company's shares being allotted to an Indian employee. Here, the shares are of an Indian company, which are issued to non-resident employees of its holding company, joint venture, or wholly owned subsidiary, subject to following conditions. The scheme has to be, of course, in line with the Indian regulation of SEBI as well as Companies Act. The ESOP should be in compliance of the sectoral caps. Issuance of ESOP in companies where investments by non-resident is under approval route also requires prior approval. And the issuance of ESOPs to citizens of Bangladesh or Pakistan are also requiring government approval, where even the normal investment is not in approval route. If the options granted by any non-resident employee, then the company needs to submit a ESOP form within 30 days of grant and within 30 days of issue. This is something similar to what you do in a FCGPR, FCTRS scenario. I think you have to go and do the necessary filing. The only thing is that you are doing filing twice instead of once. Now going to the accounting side of it. So accounting typically in case of a old accounting standards, or you can say the Indian accounting, the accounting standard. I'll not say Indian accounting standard because INDES is called as Indian accounting standard, but the historic regime of the accounting standard is governed by the guidance note issued by ICAI, and under the INDES 102, it is for IFRS adopted INDES companies. The guidance note, it talks of two methods: intrinsic value method or fair value method. In case of INDES, value calculated on any binomial model, example Black-Scholes, or any other method, all is acceptable. Now, aggregate option value to be amortized over the vesting period on SLM basis. I think this is more of a something which correlates to the intrinsic value method or fair value method or any binomial method. I think this is completely, you can say, there on all methods. Of course, in case of a graded vesting, the amortization needs to be given effect of the grading vesting. Now, coming to types and terms through which an employee becomes eligible. Now, there is something which is known as time-based vesting. Now, time-based vesting was something which I gave an example that every year 25% shares become vested. There is something like graded vesting. We say, what is graded? Whenever it is not pro rata. So we say after 1 year, he will get 25% shares. And thereafter, every month, he will get, you can say, balance 1/36 shares. Or some other pattern. I think wherever the things are not defined in a single manner, they are known as graded vesting. Milestone-based vesting could be that supposing you are giving shares to a programmer. Now you tell that programmer that once you do a go to market or go to live, and maybe at least 5,000 users have tested the product. At that stage, these many shares will vest into you. So this is some sort of a milestone-based vesting. Milestone can be customized by the client. And milestone need not be defined in the scheme. Every grant letter can carry their own milestones. Cliff vesting. Cliff vesting are typically vesting wherein either you do vesting at the beginning or at a particular, say you have a 3 years vesting period. So on the completion of 3 years, the entire shares gets vested. That is cliff vesting. Hybrid vesting could be a combination of all these 4 options. I think last line clearly mentioning again, whatever methodology of vesting you adopt, you can't bypass 1 year. 1 year has to exist. Before I get into so from here, I am starting the valuation methods. So first is intrinsic value method. I think before I get into intrinsic value method, I think we need to understand why and under what circumstances one needs to go into intrinsic value method. Normally, it has been seen in a lot of startups these days because startups, as investors, it takes time for them to believe startups. It takes longer time for employees to believe startups. So say, for example, there is a startup today and it stays within 3 years, these shares will get vested into you. And they say, okay, it will get vested. But what next? So what next means that you exercise. So they say, no, we are not ready to exercise because it will take 5 years, 7 years, 10 years for the company. We don't know how much time it will take. And we don't want to pay such heavy taxes, which you will be taking the valuation to at a level within these 3 years, 4 years. We don't want to pay such a heavy tax for exercising our shares. At that stage, most startups, either they put a 10-year, 20-year kind of a vesting, or they put a variable vesting. What is a variable vesting? They say we have a undefined vesting period. That means, undefined exercise period. That means from today, say 3 years, it gets vested into you. Now, after 3 years, till 2-3 events they can prescribe. Like, for example, if they go to listing, so they say whenever the company decides to go for listing, they will give an exercise notice. And within 6 months of the exercise notice, all the employees have to exercise or their shares shall stand lapse. Their options shall stand lapse. Or in case they don't do that, then in some cases they may say the options will not lapse, but options which are exercised after these 6 months period, all those options will have a lock-in of 3 years or 2 years whatsoever. In certain cases, they may say that there will be exercise period of 3 years or more, while the board can put a sunset and give a notice of 12 months to exercise. So there can be certain, situations in which exercise period becomes a variable item. And when exercise period becomes a variable item, we all will realize, I think when I go further and I explain the methods which we will be using to do the valuation, I think we all will realize that once this variableness in the exercise period will make it impossible for us to apply Black-Scholes or any other option pricing method. And because we cannot apply any of those methods, because there are not adequate variables which are there to make the work, we come back to intrinsic value method. Intrinsic value method is a quite simple method, but the expense calculated under intrinsic value method is quite high. That is why it is less preferred when it comes to corporates. Market price as on the date of grant is 100. Exercise price per option is 25. Number of options 1,000. Vesting period 100% after 3 years. Date of grant 1st April 23. In this case, intrinsic value is 75 per option. Aggregate value is 75,000. ESOP cost to be debited 25,000. I hope this is clear, very crystal clear example. I have not kept complicated items here so as to make it easily understandable.
Excuse me, sir, from where did 1095 days came?
3 years. The date of grant is 1st April 23 and the vesting period is 3 years. So 365 into 3.
Okay.
And how do we get the market price?
So market price तो date of grant का आपको valuation होता ही है ना, every grant date. So this is one necessary input which you ask from any client who wants you to do a valuation report for a ESOP, is that date of grant, what is the valuation? And in case that is not available, then one needs to pick the nearest valuation, preferably 6 months prior or 3 months after. I think that is considered as a reasonable basis. In case you are not able to find, then practically we ask our clients that we will have to do a date of grant valuation also, apart from ESOP valuation.
So
But
market
sir,
price
then
as
if
on
the
market
Sir-
price as on the grant date is with the future price.
No, sir. Date of grant is the date on which you issue the employee a letter that over a period of 3 years, these many shares will get vested into you. So date of grant, say today you tell your employee that after 3 years you will get 100 shares in this 1000 shares in this example. Then these the price today is the value as on date of grant.
excuse me, sir.
So if I just 1 second, I'll just finish his
Okay.
answer. I am not sure whether he has understood what I'm saying. So sir, value as on this date is what is the grant date. This is the kind of timeline I've shown: grant date, vesting date, exercise date, and the sale date. So here the price here is the market price which I am talking of. Here this market price as of the date of the grant. हाँ जी मैम, अब आप बताइए.
Sir, many times what happen, exercise price per option and number of options granted. How do someone decide that?
दोबारा बताइए, what do you mean by that?
सर कितने बार क्या होता है, क्लाइंट तो पूछते हैं कि एक्सरसाइज प्राइस पर ऑप्शन क्या होना चाहिए, नंबर ऑफ ऑप्शंस कितने ग्रांट करे, तो व्हाट इज द बेसिस फॉर डिसाइडिंग दिस टू थिंग?
This is a contractual obligation. मतलब this तो client will have. This is more of a commercial call.
अच्छा.
मतलब फॉर एग्जाम्पल आपके पास एक 100 रुपीज पर शेयर का आपका करंट मार्केट प्राइस है. अगर मैं आप मेरे एम्प्लॉई हो और मैं आपको कह रहा हूँ मैं आपको 100 रुपीज में ही दे रहा हूँ, तो आपको अच्छा थोड़ी लगेगा. आप कहोगे यार ऐसे ESOP का क्या फायदा, इट इज कंप्लीटली यूजलेस फॉर मी.
ओके, मतलब दिस इज क्लाइंट स्पेसिफिक, दे डिसाइड ऑन देयर ओन देन.
This is a commercial term. This is a commercial term where this is normally decided when somebody is structuring a ESOP scheme. The role of a valuer comes when the ESOP scheme, grant letter, granted options, vested options all exist, and you are asked to do a valuation.
Okay.
I have a certain thing to add here that in one of our client case, what they have done is that they have hired people in a startup at a lesser salary. So what they have done is, if somebody is costing them 1 lakh rupees in the market, so they are paying 40,000 rupees as cash salary to them and 60,000 rupees under the ESOP scheme. So they were like, whatever option is going to be worth to cover that lost salary will be the number of options issued to the client, to the employee. So sir, I just wanted to clarify, is that the right approach or the client is doing some blunder in it?
Client ने जो भी आपकी अप्रोच ली है वो सब सही है, but when he is issuing a grant letter, at that stage he needs to calculate the number of shares. So this 60,000 difference, for how many years he is going to grant that. So he says 2 years I will not be in a position to give 60% salary. So 60,000 into 12, 7,20,000 for current year, and maybe 8,40,000 or 9,60,000 for the next year, because there will be some increment also which I may not be able to cover. So this 9,60,000 plus 7,20,000. So a total of 16,80,000 worth of. So 16,80,000 should actually be here where 75,000 is. And we do a backworking and calculate what should be the number of shares.
Yes, sir. Is there any other method that you have seen practically as how people do the calculation of number of options?
So number of options is typically done when so most people promise it in terms of percentage of cap table. So normally, typically ESOP pools are 5% to 10% of the total cap table, and typically KMPs are given say 0.25 to 0.50 in the cap table. At the same time, there are team quotas. So we say that the development team put together will not exceed 2% of the cap table. The marketing team and the BD team put together may not exceed 1.5%. So those kind of decision makings the board does, and under that guidance, I think at an independent stage, HR along with the executive directors. So this process is completely commercial in nature. It is something like deciding somebody's salary. The number of options to be granted, the price at which those options are to be granted is completely commercial call. It has nothing to do with a valuer typically. Obviously, sometimes client may come to you as a valuer and say, his salary was 1 lakh. I am taking him at 40,000. You recommend me what will fairly compensate my employee. I think that stage you can still provide certain advisory or certain calculations. Nothing beyond that.
Sir, another query here is that when we are doing the ESOP on the base of cap table percentage, so as on date, when the company is incorporated or grant date, the cap table is usually 10,000 shares of 10 rupees, 1 lakh rupees of capital with a private limited company and all that stuff. So how do we showcase that in 5 years or in 3 years, whenever this exercise happen, what kind of number of shares will be there? Because for that, they have to increase the authorized capital and everything. So your views on that, how do we do that?
Sir, ESOP grants should never be promised in percentages. It is legally prohibited to promise it in percentages. They have to be fixed number of shares. Supposing you do a fundraise and you have already given somebody 1%, assuming, and now you have done a fundraise where you have diluted 10%, but you don't want him to get diluted. Then you issue him a fresh grant letter worth that many number of shares, which the fundraise has expanded the cap table as on that date. So it does not say that you can issue an employee a grant letter only once.
Okay, but the scheme will remain the same, right?
Yes, scheme will remain the same unless and until there is a demand from the investor to replace the scheme or to issue a new scheme. I think those are aspects which you need to decide on the facts of the typical case. In one of the cases, I think the company where we were handling this kind of advisory, the company already had a ESOP scheme. They already had a lot of granted and vested shares, but there were certain issues in the way that grant letters and scheme was drafted which could create problem, because the initial scheme said that even the vested shares which have not been exercised will rank pari passu for the purposes of AGM voting rights. Right, so the person has not exercised, but he still has a voting right in the AGM. So those kind of things were objectionable to our investors, and that is when we replaced the ESOP scheme. And of course, you can't mandate a particular employee to shift into the new ESOP scheme because he already has a grant letter. But we gave an option to all employees that you surrender your old options and you get these new options as a quid pro quo. And obviously, all the employees shifted because the management had told them that if you don't do that, this fundraise is not happening. And they all understand if fundraise is not happening, then all whatever options they have will not be worth it. I hope I could answer this.
Yes, sir.
Okay. So intrinsic value is just one method. Just give me 1 second. Shailendra, 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 Shailendra. Not listening. I am just asking him to bring certain worksheets, which I propose to show to you. Just give me 1 second. Shailendra, Shailendra, Shailendra. एक बार ना हरमन से बात करके बीना की और भी जो ESOPs की वर्किंग हुई है ना वो सारी एक फोल्डर में करके मेरे पास आ, ठीक है? I need to show to them. I requested one of my colleagues to compile certain practical ESOP valuations. I think I'll try and show you some of those. So now getting into accounting for in case of a graded option. What is a graded option? I think we'll deal with it an example. So it says the vesting period is 25% at the end of every 12 months. That means equally graded 25 options. Now in this case, every vesting date has to be treated as a separate category. So 25% get vested at end of year 1. So the entire expense for these 25% options will come in year 1. End of year 2, the 25% expense will come half in 50% in year 1, 50% in year 2. And similarly, for the third, it will be divided in 3 years, and the fourth will be divided in 4 years. So all 4 of them we'll treat as separate options. That is the example of grading vesting. So 25%, 25 options are granted with 1 year vesting. 25 options are granted with 2 year vesting, 3 years and 4 years.
Sir,
They're
what
exactly
if
same.
our year start from the mid? At that time, how we make the provision? Only for the 6 months
pro
or
rata.
for the whole
So pro rata. So in this case, if this date was 1st of October, or if this date was say 1st of November, or even if say this date was 12th of November. Now you take pro rata number of days which are falling in your financial year and pro rata number of days which are going in the other financial year, and accordingly do a pro rata expense.
Okay, but sir, one of my clients says that their year is changed just because of, I think, 2 or 3 months was there. So according to them, I have to recalculate it accordingly for till the time of their 1 year and till the time of 31st of
See,
March.
I don't know how educated or uneducated the client is about ESOP expense.
Right.
But whatever I'm telling you is the only correct way to do it. There is no other correct way to do it.
Yeah, get it.
हाँ, so मतलब client तो कुछ भी कहते हैं, सारी बात तो सच नहीं होती. And obviously clients have vested reasons sometimes to say a particular thing. Now fair value of option, because amortize किसे करना है हमने? ऑप्शन की वैल्यू को amortize करना है, और हम कैलकुलेट भी ऑप्शन की वैल्यू करते हैं. So fair value of options, typically any of the binomial valuation methods takes into consideration fair market price as on the date of grant. I don't need a fair market price as on today, except in certain circumstances. So I think we'll leave that circumstance for now. But fair market price as on the date of grant, exercise price, volatility in share price, expected life of the option, that means the exercise period plus the vesting period, risk-free interest rate, and the dividend yield on the stock. Generally, Black-Scholes model is used in most items. These are the journal entries which you typically pass: employee stock compensation expense account to employee stock option outstanding account. When somebody exercises, bank account debit, employee stock option outstanding account debit, to share capital, to share premium. And if the options lapse, then you say employee stock option outstanding to employee stock compensation expense account. This you can do normally we do a net expense every year, but in a case where in net there is an income, that means more options that got labs as compared to the amortization expense in the current year, this amount has to be shown as income. I'm going to Ind AS 1. So whatever accounting treatment I had earlier covered was for guidance note. Ind AS also does not talk something very different. Ind AS is also talking something very, very similar on same lines. Because the guidance note already had Ind AS as a reference on the date the guidance note was decided. Financial reporting of a share-based payment arrangement, recognition and presentation of effects and payment in the P&L and balance sheet, and the financial reporting of the transaction. These are the aspects which the standard covers. Now, a share-based payment transaction could be a ESOP, could be a share appreciation right, could be a trust route, could be a direct route. Share-based payment transactions is a transaction in which an entity receive goods or services from a supplier. So this could be consideration other than cash shares, or incurs an obligation to settle with a particular supplier against share-based payments. Now, share-based payment arrangement could be agreement between the entity and another group entity or another party or an employee. It could be for cash, it could be for other assets, it could be service, it could be equity instruments. So I think these are the aspects which Ind AS 102 covers, which is something quite similar to what the guidance note covers. The applicability, Ind AS 102 talks of equity settled, cash settled, and share-based payment transaction with alternatives. All transactions involving share-based payments are recognized as an expense or assets over the underlying vesting period. Transactions with employees are to be measured at the date of grant, and those with non-employees are measured when the goods or services are received. Measurement for equity settled share-based payment transaction. The goods or services received by the entity are measured at fair value. In case their fair value cannot be established, the fair value is measured indirectly with reference fair value of the equity instruments granted. Similarly, measurement for cash settled goods and services received by the entity and the liability incurred are measured at fair value. The liability has to be remeasured at each reporting date up to the date of settlement, and the changes in fair value are to be considered as in the profit and loss account. Measurement for the transactions with employees. In case the transaction of employees, the fair value of equity instrument must be used, and in case fair value cannot be measured reliably, then the intrinsic value of the equity instrument may be used. I hope this aspect is not requiring any detailing. This is more to, because Ind AS 102 typically permits non-employee transactions also, which are not the topic of the day. That's why I was little fast. I think the aspect for which I brought you here into Ind AS 102 is that the standard uses the term fair value and in a way differs in some respect from the definition of fair value under Ind AS 113. And therefore, when applying Ind AS 102, an entity measures fair value in accordance with the standard and not with Ind AS 113. कर लिया कंपाइल?
Motion. जारी का है ये? उसका ड्राफ्ट वैल्यूएशन जो था,
हाँ नाम उड़ा दे और मेरे को उसमें दे दे, नाम उड़ा के है और एक वन ड्राइव के फोल्डर में सेव करके लिंक दे दे,
वन ड्राइव पे, ठीक
हाँ, ताकि मेरे लैपटॉप पे खुल जाएगा ना. Now, option pricing, general principles of option pricing, practical usage, Black-Scholes methodology. How is Black-Scholes and Black-Scholes Merton different? binomial pricing, and Monte Carlo. I think we'll slowly touch upon the option pricing also. And of course, some aspects which are covered in option pricing may not directly correlate with ESOPs, but I thought when I'm covering, I should not leave those aspects uncovered. Value of any option, whenever you do, then you consider whether it is a European option or American option, a call option or a put option. Call option, put option is typically not aspect which one needs to look into when we do a ESOP valuation. But the terms are same: expiration date, strike price, option price, in the money, at the money, out of the money. I think these again are not typically applicable to a ESOP valuation. I think we have kept the ESOP terms here. Vesting, the process by which the employee is given the right to apply for ESOP shares. Vesting period is the period we have already explained, the period from the date of grant to the date of vesting. Exercise period, the period beyond the date of vesting, once the option has been vested, up to the period in which the employees are allowed to exercise those options. Exercise price or strike price is the price which the employee will pay in addition to the withholding tax for the benefits availed. And the market price or the stock price typically means the market price as per the latest closing prior to the date of grant on the stock exchange in case the shares are listed. If the shares are listed on more than one exchange, then the highest trading volume is to be considered. In case of unlisted shares, independent valuers valuation report for the value of share is to be considered as the stock price. Now we talk of Black-Scholes model, which is actually the most widely used model for valuation of ESOPs. This formula was, of course, developed by Fisher Black, Myron Scholes, and Robert Merton in 1973. The pricing of options and corporate liability, so not very old. The assumptions it takes that the option is European and can only be exercised at the expiration. No dividends are paid out during the life of the option. The markets are efficient and market movement cannot be predicted. There are no transactional costs of buying an option. Risk-free rate and volatility of the underlying are known and constant, and the returns on the underlying are normally distributed. I think with these options, they have structured their valuation formula, which of course looks quite complex, but I think we all know that calculators are available or Excel sheets are available widely for a Black-Scholes model. You just put a Google Black-Scholes model calculator and you get a good Excel sheet wherein you put in 5-6 variables and you have your expense calculated. So of course, what item? These are the 6 items which you need to have before you can actually calculate a Black-Scholes model option premium. Option premium is nothing but fair value of the option or fair value of the ESOP or the expense amount to be amortized. I think that is what option premium is all about. The lower the strike price for a given stock, the more the option would be worth, because the call option lets you buy at a predetermined strike price. Now, these are of course, the effect: increase in underlying asset value, the call value increases, put value decreases, increase in strike price decreases the call value, increases the put value, and the things like put is of course not typically applicable in this case because ESOPs are typically call options, callable at the end of the employees, not at the end of the company. Now, Black-Scholes Merton model, I think there's only one difference, that it also has the dividend yield captured. So this typically is not used because most of us are doing valuation for startup companies which are not profitable. So dividend is something which is seen as a very distant commodity. Accordingly, Black-Scholes model could be the right thing. Of course, in case you are doing for a stable listed company, then you may have some dividend track record, and accordingly, Black-Scholes Merton model could become applicable. Binomial option pricing model. The binomial
Excuse me,
option
sir.
pricing. Yes.
Sorry to disturb you. Sir, how do we calculate sigma in Black-Scholes model?
I'll come to that. I think I'm trying to
Okay,
get the Excel sheet sorted. I'm trying to cover the theoretical aspects, and I think then I'll try and show you how we prepare these reports of in a formal manner, as well as what are the various aspects which one needs to see.
Okay.
And how
Thank
which
you.
variable is calculated. I think that all I'll show practically on an Excel sheet to all of you. I'll not leave that unanswered. And if it stays unanswered, I'm not going anywhere, even if it clock strike 6 till the time you are satisfied.
Okay. Thank you, sir.
Yeah. So binomial option pricing model, this is typically not used, but there are two and only two possible prices of the underlying asset as on the next date. So I think this is something which will normally not apply in a case of a you can say a ESOP valuation. What is more you can say more actively used, or you can say after Black-Scholes, which is the model where we go to, I think that is Monte Carlo. Because Monte Carlo considers the possibilities, multiple probabilities, multiple pricing, and which is actually the case in which you will be able to forecast possibility. Why do you go to Monte Carlo? You go to Monte Carlo when you don't have standard deviation of a particular asset class. Most of us take some reference standard deviation and work with that and stay in Black-Scholes. There are very few valuers who go to Monte Carlo, because Monte Carlo is a very courageous valuation to do. Why? Monte Carlo simulation or a probability simulation technique is used to understand risks and uncertainty in financials, project management, cost, and other forecasts. It is a random value. So at every time you run a Monte Carlo simulation, the value comes different. Yeah, of course, it will come in a range, but it will come different. This model is calculated based on random value approach. The results of model are recorded and the process is repeated a multiple number of times. And you can say somebody takes 1,000 iterations to be a right thing. Somebody takes 2,000 iterations. So I think that typically is your call.
Excuse me, are there any calculators for Monte Carlo simulation method?
Yes, sir, there are calculators, but we typically use Excel sheets because a calculator will give you one line item. And you need to duplicate the same formula for 2,000, 3,000, 5,000, 10,000, whatever is your risk appetite as a valuer, and do an average of those simulations. And that is how you get the output. So what 10,000 duplications is not given in the Monte Carlo calculator. Monte Carlo calculator will give you one line. उसको कुछ नहीं करना होता, कॉपी पेस्ट ही करना है नीचे उसके बाद.
Are there any programs for calculations?
There are softwares. There are softwares. Typically, I do not use them, and I don't recommend them also. Why I don't recommend them? I have done it through a software today. For example, after 2 years, there is some regulator who is reviewing my valuation for some reason, and that website goes off. I do not have any backup except the output of that website, because there are no recognized software tools which are available, which are government approved or which are regulator approved. The Excel sheet will be available with me. Even if the Excel sheet is not available, typically what I do is I do a PDF print of the Excel sheet. Even if somebody opens and reruns my Excel sheet, they actually are able to see what I did and what were the outputs as of that date, and they were not fudged. So Monte Carlo method is using multiple trials, of course, this I've already explained you. We generate random values. We do best case, most likely case, worst case. And
excuse me, is it possible to generate say 2000 or 5000 random values even in Excel?
yes. So typically from between 1000 to 10,000 is what most people use. So like we use normally 2000 because after a particular number of values, your Excel becomes slow also. So you need to see how much your computer systems are supporting them.
Okay.
So we are estimating a total time it will take to complete a particular project in case it is a construction project. So this is an example which is not correlated to ESOP valuation. The parts have to be done one after another. So the total time of the project will be sum of 3 parts. Job 1, best case 4, most likely 5, worst case 7. Job 2, these. Job 3, this. Now, when you do a simulation, then you typically will get a 14, 15 as an answer because not all the jobs you will do as a worst case. Not all the jobs you will do as a best case. We did a so this is something which type of output a Monte Carlo sheet can give. Of course, it is very difficult to explain a Monte Carlo over an Excel file also. What to talk of in a PPT, but I'll of course attempt to do whatever little I can. This is of course the graph output which shows. And of course, I think my contact details are with all of you. We can connect for doubts offline and online. And now I am trying to shift to a different screen where I want to do a Excel. And just give me 1 second.
Can you please show the earlier slide, first slide, so that we can take a photo of your number?
Yeah, sure. Just a second. I'll share that screen again. And I hope it is visible now.
Yeah.
In Max over there, this over here.
Thank you.
OneDrive पे attach करके upload करूँगा। So एक में शायद से नाम रहेगा, मैं फिर से भेज रहा हूँ।
उससे तो कोई बात नहीं है। वो तो नाम तो वो तो OneDrive में भेजा है, मेल में भेजा है।
मेल से भेजा आपको, लेकिन उसमें upload to OneDrive ऑप्शन रहता है।
अच्छा, वैसे भेजा है।
इस पेज में ही स्कीम में नाम रहेगा, इस सब जगह मैं लिखूंगा।
कोई नहीं, वो
जा रही है।
कोई बात नहीं, वो कर लूंगा। भेजा कहाँ पर है यार?
Sir, your number is not visible in this.
So just one second.
Yeah, now it is better.
Inmax.com पे
अब ले लीजिए. Actually, I was simultaneously, I shared one particular screen. I was simultaneously trying to, open the Excel files. अब एक बार ले लीजिए. I think once it is done, then I'll switch to the Excel files.
Go ahead.
Yeah, thank you. And yes. आप मेरे को ये जीटी कौन सी जा रही है? ये है
हाँ, वाले सब पेज में बस एक जगह नाम रहेगा।
कोई बात नहीं. स्कीम वाली कौन सी स्लाइड है? ग्रांट समरी,
ऑप्शंस प्राइसिंग मॉडल KCD2।
यस. जरा आगे बताओ। Just give me 1 second. I'm just trying to open all of them and then I'll go to that.
एक और है सर उसमें,
कौन सा है?
ये ऑप्शन प्राइस सेकंड पेज यहाँ पे कहाँ आएगा? डाउनलोड कैसे होगा? मेरे को वो भी उससे ना अर्बन से लेके अभी हमने जो दो, एक वो यूएस वाली करी है ESOP वैल्यूएशन। जैसे
हाँ
वो ओएस जो फाइल है वो वही है।
अच्छा ठीक है,
ओपन से
ठीक है। ओएस वो है और जीटी ये बाकी दो को जाने गया।
बजा
बीरा मेरे पास है, ठीक है। It's, I think this is a ESOP valuation working, which of course we have already delivered a report on, but I'm trying to show things which will become relevant for all of us. So we say date of grant was say 2nd of March. Options granted, these are the number of options which are granted, total number of shares, face value, what is the pricing model. The shares have been issued at a discount of this to the fair market in terms of the ESOP scheme. So of course, this is for a listed company. So listed share price is available. And
ये थोड़ा बड़ा कर देंगे, दिखाई नहीं दे रहा है ठीक से।
बड़ा और बड़ा कर देता हूँ मैं।
Thank you.
Better. I've tried my best to remove client name. अगर कहीं दिख जाए तो ignore कर देना, मैं यही कह सकता हूँ। ठीक है। Exercise period will be say 8 years. Lock-in provisions are not applicable. Vesting, they said 0% shall vest at the end of 1 year, 10% at the end of 2 years, 20%. So these are the vesting terms which are given in this case. And this, of course, we took out BSc and SC, and wherever the larger volume is there, I think those were taken. Now, listed company, yes, data source from BSc, because of course they had BSc, large volume, closing this, market price on the previous closing this, discount, and we determined the options to be granted this. This is the conversion ratio because the face value is 1. Exercise price is 980, 101 rupees 40 paisa was the discount. And
2 discounts are shown. What are they?
So because they have multiple type of grants. I've shown you only one scheme document. So there are 2 type of options which were granted on the same day. One had 57 rupees discount, and the grant date was also different. So you even see the price is 1037 in this case. So they are typically phase 1, phase 2, multiple phases options which are valuation is being mixed. So this is the practical scenario. This is not a theoretical case study. That is why it might feel sometimes more complicated, but I'll take you to aspects which are most relevant for us. So
can you please share these Excel sheets and
नहीं सर, ये तो नहीं शेयर, ये PPT शेयर कर दी है मैंने already. PPT is already with the RBO. Okay. I shared it last evening with them. Excel sheet share करना possible नहीं होगा.
Since the names are deleted, I think the anonymity is maintained.
हाँ, but sir, still there is a lot of IPR which goes into creating these sheets.
Okay.
So say the grant date is this, the vesting period is, if we typically go back here, at the end of 1 year, there was 0%. So that is why here we have taken 2 years, 3 years, 4 years, 5 years. Exercise period in terms of years is 8 years is the total life. So 8 minus 2, 6, 5, 4. So 8 years is the total period of the scheme. Out of which, if vesting is 2 years, then exercise will be 6. So typically how that breaks up. What will be the vesting date? What will be the last date to exercise? How much options are eligible to be vested as on which date? And options eligible to be vested. I think this is what has been calculated in this sheet. I hope this part is clear. Right. Now I go to the next sheet. Now this input we calculated in the previous slide. Here I have put a probability. I say 25%. So why I could put a probability is because there is a trend which is available in the company. This is a stable, large company. And we say that typically 25% of the options we grant are never exercised. Or they even sometimes before vesting, they expire because the employee leaves. So that is why we have considered only 75% options for the purposes of expense calculation. Now, fair value using Black-Scholes model. This, of course, we have calculated in the next slide. We'll go there. Yes. This grant date 9/80/1081. Expected life is 5 years. So this is, of course, done for each of the items. Volatility also, I'll show you how volatility has been calculated. Risk-free rate, dividend yield, vesting life, vesting period after vesting, last date to exercise this, total vesting period. So I think the step 1 is we take current share price and the strike price. The result is this. So the natural log result is this. In the step 2, we do a square of volatility divided by 2. We reduce the dividend yield. We add the risk-free rate, and then we get the result. And this will be multiplied by the expected options life, comes to the result. Step 3, we do a square root of the expected life, B10. B10 is 5 years, times the volatility, and we get the result. Step 4 is A plus B by C, where you get the D1. We also, whatever results we've got from D1, we reduce C from it, and we get D2. The normal distribution of D1 is calculated because these are all inputs which will ultimately help me achieve the current share price again times the dividend impact, and we get the result. We times F, and we get the result. Thereafter, we do a risk-free rate times expected life times -1, and then we get the result. The exponential result is calculated on this figure times the strike price. We do a multiplication. We get the normal distribution figure, and this is the result. And last, we do a G minus H, and this we get the value. This is a more detailed way of calculating. Most calculators will only ask you these inputs, and all this activity they will be doing in the background. We've tried to capture it on the face in this report so that you are able to see what is happening there. Now, coming to from where I am picking up, typically ये जो ऊपर input लिखे, most calculators only ask for these input, and rest of the formula which I have structured below is actually built into a macro. For a stat, देखो जैसे यहाँ नाम आ गया है, in spite of best efforts. This is how we do a standard deviation calculation. Risk-free rate, of course, one is taken from the what is the maturity tenure which is applying. Dividend yield again is based on the whatever is the dividend yield which is currently flowing on the project. So I think I explained this particular Excel sheet. I think this one is similar, so I'll not explain this one. Only two versions of the same file. Yes, I think this is interesting. Now, what I typically covered earlier was a Indian scenario wherein the options were getting vested. Now, this particular item is a US holdco which has subsidiary employees. So I have done an expense calculation for the Indian subsidiary, wherein there is a US holdco whose ESOP have been granted, and those ESOP will be settled as a bonus ultimately. Of course, the scheme does not say so, so that is why we have captured grant vesting, but the past trend shows so. All the options were granted in the current year. There is no option which existed pre-granted, because I told you that they settle most of the options which get vested in cash. That is why there is no other open option. 10th November 22 is the grant date, and typically this is the estimated vesting date based on the schedule which is provided by the company. It is at the end of 1 year 25%, and thereafter 1/36, the way I told you, and all these options get vested. This is the closing balance of the options. So employee-wise, exercise period is 9 years, because the total life of the scheme is 10 years in this case. In the earlier example, it was 8 years. Accordingly, this exercise period is coming as a differential in each of the items. Expected life will be half. That again is an assumption. You can assume it towards the end, you can assume it towards the beginning, depends on what is the fact in a particular case. Risk-free rate being continuously compounded, and then we use a fair value. Just a second. Fair value of the Black-Scholes pricing. This will let us go there. How this has been calculated. Value as of the grant date, equity share value as of the grant date, exercise price is same, number of periods is 5.5, risk-free rate is this, standard deviation this, present value exercise period this. So in this case, I have not done a detailed working as was done there. I have done the abridged version of the working. And accordingly, we calculate the total ESOP expense for each of the line. Each line is created as a separate valuation for us. And we do a 365 days, because this is for 1 year, at the end of 1 year. So period is 365. This is 395. Accordingly, I calculated what is the daily expense. Expense up to 31st December. I calculated 10th November to 31st December, how many days were there. Because we were doing both for the group reporting as well as for the financial year of India. and we say from January to March, what will be the expense in this case? And accordingly, these total are actually the two deliverable items. I think this is all in this to be explained. And yes, this I have already explained. I know one more valuation which I did quite a number of, two more rather. I don't think so. It is saved here. I think there are typical aspects to be seen in those valuations. Let me just dig them out from the server because it will be very helpful for you to see them as case studies. Just give me 1 second. I'll pull it out. So this is one particular valuation. So the only aspect which I wanted to touch upon here was that in case of every employee, this company had a different vesting schedule. So typically we had, or rather, I'll not say for every employee, but typically they have these type of options. 100 type 1 options where 100% get vested in 1 year. Type 2 options where 15% at the end of first year, 25% second year, 30% third year, 30% fourth year. Type 3, 25% each year. Type 4, 25% in first year and balance in 36 months equally. Type 5, 50% in first year and balance in 24 months equally. And type 6 equally in over 48 months. In a one single valuation for a one single actual client, we had to do so many different cases, because actually we broke it into how many types, and even the number of options which became vested, I think they were calculated like this, because if you do a filter, you will see all the types calculated separately and expiry term, and accordingly these items are coming as a formula. So I think the only aspect which I wanted to show you here was that how complicated ESOP valuations can get just because of the way the scheme down. This, of course, very old. I think 2011 we did this valuation. And so not every day you get something of the same sort. One more I'll show you. I think I may not have the Excel version of this file readily on my system, but I think the only objective of showing this here was that in this particular case, the company did not have a defined exercise period. Right. So what and if you see the initial years, the date of grant and the fair value of the date of grant, whatever price, there is no intrinsic value which is available. Here we have used the intrinsic value method. And accordingly, we have calculated the valuation expense, which is coming to in the later part, there is some valuation gain which is coming, based on which we are doing the valuation difference. So the only aspect which one needs to see here is that the company did not have a fixed exercise period. And that is why I had to adopt the intrinsic value approach, and I could not have adopted a Black-Scholes model. The same company in a subsequent year passed a board resolution and a shareholders resolution, plus a resolution in the meeting of the employees who had options granted, stating the modification which I was telling you, that on a listing date, there will be a 6 months notice. And then the board gave that within 3 years, we'll go listing. Accordingly, we were able to define the exercise period, and we shifted from intrinsic value to Black-Scholes model in the subsequent year. I think these are all examples and what all I could compile. I think there is one more aspect which the RVO requested me to cover, but I think before I come to that aspect, I think over to you for any questions which are related to the ESOP valuation.
And what is the best method and easiest method to go for ESOP valuation?
Black-Scholes, best and easiest. Sir, intrinsic value, the basic issue and the basic problem is that your expense comes too high, because it does not apply probability, it does not apply the future, you can say, similar to what in a actuarial valuation, the leave encashment or a gratuity expense will come lower as compared to what if you do as a chartered accountant, you calculate the gratuity liability and you provide it in the books of accounts. It is similar way Black-Scholes work. So a Black-Scholes calculator gives the lower expense value. So if you don't want to disrupt your P&L, you have to find a way that the client stays with Black-Scholes. That is the practical advice.
But is it not difficult to or cumbersome to calculate the standard deviation?
सर अभी तो बहुत आसान हो गया है.
Yes, sir.
हाँ, अभी तो सब we have to do it even for normal valuations. There is so much databases available, and Excel is available to all of us. I think 20 years, 30 years से तो कोई दिक्कत नहीं है. उससे पहले when maybe the previous generation to be those valuers might be doing it, they might face it difficulty. We have a lot of tools. I don't think so standard deviation has we have any issues of any kind whatsoever.
See, the case of say startups or companies who are not paying any dividend, it is a plain vanilla for using Black-Scholes. But where dividends are paid, then it is not a difficult exercise.
So the example which I showed you was for a listed company. I had captured dividend yield also, and I had gone to the modified Merton model. So I think that was the first Excel sheet which I had shown you. I of course have a lot of run-of-the-mill valuation, but the 5-6 I picked up were the most complex ESOP valuation I have come across. Of course, there could be some which I have not come across, which could be more complex scenarios.
After the Black-Scholes, what are the other models you prefer?
Mostly I have used Black-Scholes or intrinsic value. I have not gone to Monte Carlo for a ESOP valuation. Typically, though theoretically speaking, you can go to a Monte Carlo. When do you go for a Monte Carlo valuation? When your vesting period and exercise period both are not fixed. They are a cliff option or a milestone based option, because then you will have to do a probability of the vesting date and accordingly calculate the ESOP expense. So either you do at an assumption basis or you do it through a Monte Carlo.
How about fair value based valuation?
Fair value of what? Fair value, everything is fair value only. Intrinsic value is also fair value, and Black-Scholes is also fair value. I didn't understand the question, sorry.
Because somebody told, let's say there are methods like fair value, then intrinsic value, etc. And I thought these two are different.
No. So I'll tell you. The intrinsic value method here is not same as the intrinsic value valuation. In an intrinsic value valuation, typically you talk of the book value. I think that is not what intrinsic value method here is prescribing. What it is prescribing is that you already have a fair value of the equity share as on the grant date. Now you have a exercise price. Say exercise price is 25 rupees, fair value is 100 rupees. The difference 75 is what you need to expense off. Now, because you do not have the exercise period which is defined, you have to shift to intrinsic value method because Black-Scholes formula does not work. So either you can assume an exercise period or you shift to intrinsic value. These are the two options which you have. So intrinsic value is not that your book value of the share is 40 rupees and I'm doing a 25 and 40 difference. I think that is not what I'm recommending. Unless and until somebody has done a NAV basis valuation as of fair value as on the grant date. But intrinsic value here is something very different. It has nothing to do with the book value. So both intrinsic value and Black-Scholes here in my examples were based on fair value approach only.
We have to go for valuation of the fair value of the company.
Yes, sir.
Excuse me, sir.
Sir, can you repeat the question, please? EV Shiva Prasad, sir, if you can repeat your question, please.
I was commenting that to say the fair value of the company or share value of the fair value of the share is to be calculated by the valuer.
So typically then your example, your assignment becomes twofold. One is a ESOP valuation or a ESOP expense calculation assignment, which is the second phase of the assignment. The first phase of the assignment is that you calculate fair value of the company at each grant date.
Yes.
Right. So this is typically a normal security valuation. This has nothing to do with today's subject. Because today's subject, we are only covering your phase 2 of your assignment. We are not covering the phase 1.
Sorry, sir, can you repeat this aspect, please?
So I think the sir asked a query that in case fair value as on grant date is not known and a client comes to you for ESOP valuation, what do you do? So I say that you divide the assignment into 2 phases.
Yes.
Phase 1, where you have to calculate fair value of equity share at each grant date. Phase 2, wherein you have to calculate the ESOP valuation or the ESOP expense amortization.
Okay. In that case, it will be just the valuation of the company.
Correct. So that valuation is typically not covered by me today. It is not the agenda today. That is why I have not touched upon it. I have only touched upon the phase 2 of this assignment.
Okay.
I think coming to yes, sir. Sorry, please continue.
What happens if the balance, suppose the assumptions that we have taken, suppose risk-free rates, volatilities, these changes over a period of time. So do we also revise the model and change our assumptions accordingly or not?
Typically, what I have followed is I take these all these items as on grant date. Okay. So when you take everything as on grant date, they don't change.
Yeah.
They will change for future grants. So like the example of the listed company which I had taken, sir raised a question that there is a 57 rupees somewhere and somewhere there is 104 rupees, 101 rupees 40 paise. So that difference was there because there were 2 grant dates which were being considered. for the two type of grants which were considered for in a similar period for valuation in the same report. Typically, you do a valuation in the year of grant and it continues for future unless and until there is a change in the number of outstanding options or there is a, employees have left or the things like. I think if there are no changes like this, I think whatever expense I calculated, because I gave a year-wise expense calculation in my report, those expense remains true if your employees don't leave.
But it seldom happens. Basically, employee
हाँ सर,
leaves.
वो तो अच्छी बात है ना. Every year we get an assignment. Why should we bother about it?
That's true. That's true. And is there a way that or is it specified in the regulation that we have to follow only one method, or we can do a football field and have multiple methods, give them
Then I
rates?
think regulation cannot specify everything, and that is why we exist as a class of people, and we need to apply our judgment. It looks very complex when you start doing the first ESOP valuation, but believe me, it is the simplest exercise. It is much simpler than doing a security valuation, and clients are ready to pay good price also. Typically, most ESOP valuation range between 75,000 to 2 lakh rupees as a valuation exercise, depending on the size of the client. No client wants you to do ESOP valuation in 50,000 rupees. I think I have not seen a client expecting so, and I have not done an assignment below 1 lakh, even in 2011 when I used to do it. We've kept some premium always for this particular activity, and we've been able to keep because it is the knowledge of this is limited to a limited few of us.
I got an offer for 30,000 rupees.
सर वो ही बता रहा हूँ ना, आप उसकी रिपोर्ट भी पढ़िए. You will get to know where there are the errors. I can bet the report will not be factually correct, because there is so much work involved. You cannot do it in that kind of a price. I think we'll leave ESOP at that, because I think I have last 15 minutes left, and I think the RVO wanted me to cover one particular aspect which is not to be covered as a presentation from my side, but is to be more covered as a discussion. I think all of us have experienced that IBBI is coming out with certain judgments, certain orders against fellow valuers. When we read them, all of us get worried. How do we cover up? How do I do my valuations better? That I am not the person against whom there is an order. I think that is the aspect which we want to focus last 15 minutes on. I want any one of you, maybe if you have gone through any of the order, I don't want to name those people against whom the order has been, because at least I can say so, it happened against these people, but there are many valuers who are doing similar practices. They have been, for the people who have been unfortunate to be singled out. I'm not saying, I'm not defending that they were not at fault. Definitely they were at fault. That is why IBBI came up with the order. And I think such orders will only strengthen qualitative professionals to continue in valuation. And people who are not serious about valuation as a profession may not actually focus much about it. So I think I want any thoughts, anybody who has read any of the orders? I think there are 4 or 5 of them who have come out.
Yes, one was regarding some not due diligence which has been followed by a valuer. Due diligence
So I think,
of the fact. Yeah.
So I think one aspect was that IBBI makes it mandatory for you to carry out a visit in each case. Whenever you are performing a valuation, in one of the valuation, the valuer admitted that they had done a valuation report at the time of CIRP. They are the valuer at the time of liquidation also, and they did not do a repeat visit for valuation under liquidation for all locations. They did it for 1 or 2 locations, but they did not do a repeat physical verification. I think this was an act of negligence which was classified by IBBI. I am not saying anything against a particular person, but in my humble submission and suggestion, if you are a valuer at CIRP stage, please don't accept that client at liquidation stage. You've already expressed that opinion on that particular aspect. I think allow another valuer to evaluate it at liquidation. If the COC feels that they need another valuation, I am sure they are looking for another opinion.
So one of the problems which we face as a land and building valuer is sometimes it is very difficult to measure the sites or the parts of the structure. Like very recently, I had visited one site where there were the pug marks of so many leopards and tigers there. And it was very difficult. It was so scary even to bend also to take a measurement of the structures. And it was totally into a jungle, that property. It was very difficult. Now, how to put across that? And we were seeing those bug marks and the marks of the nails and all on the trees. And those people, the local people were telling that yes, here there is a tiger also and leopard also. And they are killing. Now, this is the practical problem we face.
I think we should, if we are not able to do a particular, my suggestion here is, of course, I'm a SFA valuer, not an expert on land and building valuation. But my suggestion here is that if I'm, in spite of best of the diligence at my end, if I'm not able to reach a particular factual conclusion, typically in case of a IBBI assignment, because in IBBI assignment, there are a lot of incompleteness of information which is available to all of us. We should clearly disclose the entire methodology followed, the kind of information we requested, the kind of information that was denied, the kind of information that was received, what is the limitation to our scope in specific case, and what are the conditions which were there, and how we have reached to that best estimate of valuation which we are giving in our report. I think if you do entirely a full disclosure, because if you actually read some of these IBBI reports, IBBI has raised questions on why you did not disclose what all work you did. You've just given a value without detailing the aspects of valuation. What methodology was followed, which particular valuation standard was followed, which particular method was followed, what is the working of that method. I think all of that needs to form part of your report. We can't give an abridged 5-page report and say we did a lot of work. Give a 40-page report, cover everything in the report. In any case, IBBI report is not, the valuation for IBBI is not published anywhere. It is considered closely within the COC. So even if there is a confidential information which is included as a part of your working, it may not impact. Or you can refer an annexure, which you can say that the annexure is confidential, may not be circulated with the report, but is being prepared and submitted to the COC for their digestion only. And you can give part A and part B of the report. Part A can be the value opinion, part B can be the working. I think वो हमें करना पड़ेगा. तीसरा, one more aspect which in one of the cases IBBI covered and gave an observation. I'll not say that they gave a order against, they only gave a warning. I think in this particular case, there was no judgment against the valuer, but it was the case of a SFA valuer where the SFA valuer had accepted as SFA and did not value inventory, where the P&M valuer had also accepted as P&M and did not value inventory. So it was only given as a warning that in case you and in the process, what happened that the COC approved the total valuation without considering the value of the inventory. So they said that the clear demarcation of who is doing what, who is covering inventory, should be clearly done at the end of the valuer also and at the end of the RP or the CD also. Because what they said was that if you are not doing inventory, if you're not treating inventory as a part of SFA, please clarify. Don't clarify in the report. Please clarify with communication
not?
with your RP that I will not be covering inventory.
But say if it is in the appointment letter, if it is not mentioned that ESOP valuer has to value the inventory, then why should we even mention
So
that?
that is what IBBI said. It has to be clear. You can't leave it on probability that who will be doing inventory. And by default, IBBI classifies inventory in SFA scope. Though as SFA valuers, some of us or most of us find ourselves incompetent to value inventory because it is not a running business. There is no continuous sales happening. If there was continuous sales, I could have done a valuation. But if there is no sales trends which are available, how do I do a valuation if there are no recent purchases which are free from material fraud or error? How do I do a valuation? I think that is why. Haji?
Sorry, it becomes a tangible asset then.
Correct.
Inventory becomes a tangible.
Sir, so that is why it becomes very important for us to clarify it pre-acceptance of the engagement or while submitting our quotes itself that we will not be covering inventory. And that is why I think most of the RPs have started preferring giving IBBI assignments to valuers who are empaneled in all three classes because they don't want to get into that hassle. Who is doing what? They want the complete value from one single report. They don't even want to get into the hassle of totaling those three values.
So individual valuers will be out of business.
I'm not saying so, sir. India is a very large country. Nobody is out of business because of a particular trend. I think individual valuers have their own capability and their own credential. We run an entity in spite of that. For like my engineer is a mechanical engineer, the plant and machinery engineer who is a part of my entity. If I have a chemical project, I have to go to an outside plant and machinery valuer. If I actually do it, okay, he might be eligible to sign, but is he competent? And if I lack competency and I deliver a particular assignment, I can be sure that tomorrow there can be action against my negligence. Obviously, sometimes you may say, sir, fees ही इतनी कम होती है, कहाँ से जाएंगे बाहर, कैसे outsource करेंगे? ठीक है, sir. I think we all have a call how much we need to quote. Nobody pushes the assignment on us. And I can tell you, there will be filtering. People who will keep their bar of their performance high will survive, will get branded. There are people who see your work, they give you a call. वैभव आपसे काम कराना नहीं किसी और से, आप बताओ कितने पैसे लोगे. There are people who recognize you because good quality valuation is very, very material for anybody. Any other questions, any other aspect anybody would like to add on the topics which I raised? Anything which I untowards said which I should not have said, because there are a lot of people who are far मतलब मेरी जितनी एज नहीं है उससे ज्यादा एक्सपीरियंस वाले लोग भी अटेंड कर रहे हैं सेशन, तो कुछ गलती हुई हो किसी के लिए तो बहुत बहुत माफी.
ऐसा कुछ नहीं बोले थे आपने.
Now only thing is that valuer bill should come, because it is very much important now, especially with we land and building valuers.
Sir, let us work towards a self-regulation and not ask for more and more regulations. They will come. Regulations and code of conduct will come. They will improve our value as a profession also. They will improve everything. But I think let us not say that when the regulation will come, then only I will start working properly.
No, sir. The problem is that we people are facing the competition with people who are just simply an approved valuer with a very feeble background.
Sir, weed out ho jayenge. A lot of people have stopped accepting assignments after IBBI judgments. Do you know this? Lot of people have
wanted to share.
Yes, lot of people have surrendered the assignments which are in progress. right? Because after IBBI judgment. So if IBBI is getting particular, it is in the interest of all of us who want to do quality work. At the same time, I think Divyajyoti RVO and other RVOs are working hard that wherever IBBI has taken a stand which is practically not possible for valuers to follow, I think they are trying to soften their stand also. So I think it will be both working with IBBI to understand our aspects. At the same time, IBBI, if they weed out 5 bad people, we can be sure that at least 100 of them will withdraw themselves. Or 5 or 10 of them who want to continue will upgrade their skill set. Why the Divyajyoti RVO wanted me to discuss this for 15-20 minutes? Because they want all the RVOs, all the RVs who are associated with them to upgrade their standard. To work towards a better, a more transparent, a more capable valuation team. All of us are a team. I think we all have instances where one valuer consults other on a peer-to-peer basis, on a one-to-one basis, and tries and achieves the desired output. Thank you so much.
What was that?
Yes,
There was
sir.
one question on chat box. Just now.
I'll just
Let's
see.
try.
I'll just see. In case of a merger, if the client is not consenting to get a separate valuation done for land and building, if you are using asset-based approach, then it is not possible for you to sign it as an RV. If you are using DCF approach and this particular land and building is an operating asset, it may still be feasible. But I think I'll suggest one particular check, that the circle rate should not be more than your overall valuation. I think that hygiene check you can do if you are treating land and building as an operating asset. While if it is a non-operating asset or it is an asset-based valuation, you don't have a choice but to go to land and building valuation. Or in case the land and building has been purchased in last 3 months, 6 months, you can assume the purchase price.
What are the suggestions would you make to save ourselves from the adverse remarks by IBBI? What precautions should we take?
Apply your sixth sense, professional judgment, professional skepticism, जो सालों से हमारे को कहते हैं. I think if we all apply that carefully, there is no reason that IBBI or anybody, for that matter, will be able to raise any kind of observation on any of our reports. And I think RVOs are also playing a very good role. The peer review exercise is not like a policing exercise; it is more like a friendly match, where all of them are advising us that this aspect you need to strengthen, you need to change. I think there's a lot of good value which the peer review aspect is also adding into the. I don't know how many of you have got yourselves peer reviewed, because as of now it is a voluntary exercise. It is not a mandatory exercise, but I think I recommend that get a peer review done, whether through the RVO or informally have a NDA signed with a peer valuer and get a formal peer review done from him. You will have a lot of insights into what all you need to change.
How are valuers picked up for peer review?
I think that I am not the one who does or picks up, so I'll not be able to comment. I don't do peer reviews. I don't pick up. So I think I am a wrong person to ask this question.
Generally, what time period? Like after 1 year and 5 months?
As of now, peer reviews are done for a 1-year validity. Okay. But I think as a profession gains vintage, I'm sure that they will shift to a 3-year or a 5-year validity as permitted by IBBI. So there is still some clarity which is yet to come, and till the time a regulation is mandatory for any class of valuation, I think the standardization will take time to come in. We are all, even valuation as a profession is still, I'll not say it is a new profession, but it has got a new avatar in 2018. And I think we are still taking the shape into the new avatar, and the valuation bill and the call of whether it will be all, there are a lot of things which are going on. whether IBBI will be the regulator or there will be another regulator which will be set up for valuers itself. I think all those aspects are being considered, and there are a lot of talk, lot of discussion, lot of debate. CEP program is not the right place to do it, especially when it is a recorded program on a virtual mode.
Right.
Thank you so much, everybody. Thank you, Divya ji, for inviting me and making me part of this forum. And thanks to all of you for making the session so interactive and so enjoyable for me.
Thank you
Thank
so
you
much.
very
Sir.
much. Very good
Thank you
learning.
very much.
Jen Saab, just 2 minutes for me. I am SP Sharma, chairman of Divya Jyoti Foundation. I am independent director. So we have come to the end of this CEP. Thank you, Jen sir, for taking this assignment and covering the topic very nicely. You have covered the topic both theoretically and giving practical example. And there was a good interaction between the participants and you. Very nice. As number of cases of disciplinary action were increasing, we thought this aspect should be covered in today's CEP. Thank you for giving it very nice coverage. And thank you participants for participating in this CEP. Please share your feedback. Thank you, Kajal. Thank you, sir.
Sharma ji, just I want to add one word. Say, not only the subject matter, the ROG has taken the right call in discussing about the matters like SBI, IBBI SAP review. Thank you very much. I think it is need of the hour.
Because I have seen ever since I'm with this RVO, earlier most of the cases used to be for IP, disciplinary cases for IP.
Yes.
But of late, I have seen there's some spurt in cases pertaining to valuers also. Okay, we should carefully read the judgments and take adequate precautions, whatever the concerned valuer has not taken.
Thank you so much. Thank you.
Thank you, sir. Thank you.
Thank you.
Thank you.
Thank you, sir. Thank you, everyone.
Thank you, sir.
Thanks, Rajesh.
Please share the PPT.
Yes, sir. We will share.